Good morning, ladies and gentlemen. Well, the risk dial, according to my calculations, is at roughly minus 15. So slightly improving, but certainly not giving any signals that we are about to enter a strong risk on phase. Let's have a look at what the bonds are saying, and from that we should be able to derive some trading ranges for the risk assets, which could definitely be busted by the actions of the central banks over the next couple of weeks. We have the ECB followed by the Fed, and I think inflation is continuing on its course, and we are probably going to have some quite exciting action in the bond markets over the next couple of weeks. The yield curves are still asleep. My favorite part, the 530s, it just keeps on trading around the swing level of 20. Couple of basis points above, couple of basis points below. It just doesn't seem to have made up its mind, and I think it will do in the next couple of weeks. I think if the Fed comes out with all guns blazing and keeps on saying that it will continue to come out with all guns blazing, I think the likelihood is that we start breaking above the previous highs and get back into trend. We shall see if that is the case. But certainly my favorite direction would be more flattening of the yield curve and possibly going negative again. If we look at the individual tenures, this period of consolidation has actually, what it's done, it's given us the ranges, both on the dailies and on the weeklies. You can see how clear everything is. Basically, the 5-year note through 308, and it has air. If we enlarge this, we will see that there is absolutely nothing above 308. This was going to be a massive signal that not only if we break 308, not only are we going higher, but we're going significantly higher. We will go up towards the 350s. If we look at the 10-year note, it's less visible, but basically the level that we need to break is 323. Above 323, all kinds of bad things happen. And in the 30s, that level is, as you can see, it's going to be a very hard work to start breaking above 345, and that's why I think it'll be 2s, 5s, 10s, 30s in terms of reaction functions to the upside, and therefore I think the odds are that the yield curve flattens and even goes negative. I really don't think there is that much downside in any of these markets, not until CL turns, not until oil turns, and that would be a signal. But until that happens, you're still looking to the upside, you're still looking for higher prices, and we have some very, very well-defined ranges. We start breaking up through this 322 level, and it's going to be very, very bad for all risk assets which are tied to yields. The main reason why I think that US yields are likely to break higher is because they are breaking higher in Europe. Now, this is a monthly chart of the 2-year note, and as you can see, basically it's breaking every level. I'm absolutely convinced that it will trade here around 110. Certainly higher than 1%. And really, you can't see that from anything else but from a monthly chart. This is now a weekly chart. What does that tell you? It basically tells you that we are still probably in a third wave higher. You really have to look at monthly charts to have any kind of idea of what the scale of these moves is. So that is the 2s. If we now go to the bobble, there is just no retracement. From this monthly chart, all I can see is that we are likely to trade around 120, and then we see. And with the ECB now on next week, what it tells me is that the market has got the bit between its teeth, and it will just continue to spike higher. That's all that I can see. This is now a monthly chart of the 10-year of the bunds. What does that tell me? Well, it tells me that the likelihood is that we go and trade towards 170. And that's all I can see, that these are very strong moves up that certainly cannot be resisted and should not be resisted. That is the path of least resistance, and basically keeps on going until and unless oil turns around. While oil is doing what it's doing, I cannot see anyone stepping in front of this freight train. And if we go and we have a look, and sorry, this is now the French market, which tends to be the clearest chart. This is again this is now a weekly chart, as you can see, and really it's broken through, and basically it's saying that it's going up here at the very least towards 216. These are very powerful moves. I really see no reason whatsoever that the yields in Europe will not be quite a bit higher within the next couple of weeks. And that tells me that that trend is likely to happen in the US as well. This is worldwide inflation, and the bond markets are adjusting accordingly. This is the differential between bunds and 10-year notes, and as I have been saying for a while, I just cannot see it sustaining the 200 basis points level. And I can't see it because inflation is a worldwide phenomenon. At some stage, the European Central Bank has to let their rates catch up with what the market is saying, and with the higher inflation. So to me, this is going to be really, really important, this area between 158 and 153. What happens if we start breaking down through that area? Well, what happens is probably that the dollar gets slightly hit. And I do think that that is likely to happen over the course of the next several months. I think that inflation being this worldwide phenomenon is going to ensure that the rates in Europe start catching up with rates in the US. And then the only central bank which will be left out of sync is going to be the Bank of Japan. And that is why you are likely to see the Japanese yen, as opposed to the euro, being the currency that suffers the most. The dollar actually had a relatively quiet week, but it's because the composition of DXY is what it is, with 60% being in the euro, and a very small proportion in the yen. The moves are all happening in the yen as opposed to in the euro. And really, what can we expect? We can expect the DXY to remain in a range for the time being. You saw the differentials coming in between the interest rate in the long interest rates in the euro and in the dollar. I think that is likely to persist. That pressure is likely to persist, in which case really the DXY is the one that's getting pulled in every which direction and is really not indicative. If we turn that now to the Euro USD, you will notice how basically it's just range trading, but with an upward bias. I would have thought let a few days go by, and then we can probably have another move higher in Euro USD towards 109, 110. But that should not fool you. It's not a dollar move, it's more a euro move, that the euro will be strengthening against everything rather than the dollar weakening against everything. So, but the real moves are happening here in the dollar yen. You can see how basically we've retraced everything in dollar yen, from this 127 level all the way to up to 130, and now we're likely to have another 135. There's very little going sort of in its way towards 135. So the weakness is in the yen. The weakness is not in the euro. The euro is not the one that you should really express any dollar bullishness in. It's actually the yen. And it's quite obvious that as the Fed and the ECB now take on a more aggressive role, the only central bank left out of step is the Bank of Japan, and basically all assets are fleeing the yen. Gold in dollar terms is doing absolutely nothing. It's range trading exactly within the levels that have been working all year, basically 1881 being the top. We didn't quite get to 1881, we got into 1870s, and in one day smack all the way back down to 1850, with 1830 then being support, which will probably give way, and then we trade in the low 1800s, with 1764 being the absolute line in the sand. While interest rates and bonds, as I showed you, are more likely to go up in yield than down in yield, this situation will persist, and the downside is going to get probed in gold. As real interest rates rise, gold becomes less and less attractive, and the downside gets probed. I really would leave gold alone for the time being. I see no opportunity until and unless the central banks blink and abandon this whatever it takes fight against inflation. While that is going on, I really can't see gold making too much headway. The headwinds are just too strong. Every time yields go up and real yields rise, it's very, very difficult for gold to follow to the upside. It looks like gold DBC is going to make me suffer for quite a while. It is relatively cheap. Look how far back it's a third of the price that it was at the height, and therefore it's what this chart tells me until this turns, and it's probably going to take many, many months to turn. It's telling me that gold is relatively cheap, but that doesn't mean it's going to go up. It just means that it's not going to go down a hell of a lot while DBC is in a bull phase. And we can have a look at DBC on the weekly. You can see it's made a new high, it's closed on a new high, it's broken this very important 2973 level, and now it looks like it's going to trade up towards 32, which is basically the all-time high. Given that background, I really cannot see bond yields liking that, and it is what it is. Probably another powerful move higher towards this 32 area, which is going to have the implications that I've just given you for bond yields, and therefore it's also going to affect risk assets. If we have a look at a chart of oil, that is as clear as can be on a monthly chart. We are breaking higher, and basically we're looking to test these levels around 140 to 150. We are on the weeklies, we're also breaking. This basically then just becomes another wave, and I really would not be surprised if we break the 130 level on the weekly and basically test this kind of level around 140. While that is happening, I think the likelihood of bond yields going down are almost zero. And I think it's more likely than not that the Fed and the ECB are going to have to intensify their fight against inflation rather than anything else. I think DBC and oil will become a much better indicator of what the central banks are going to do, simply because the central banks have nailed their flag to the mast. They will have to follow the price of oil because energy is the source of the inflation, and therefore as energy still rises in price, the likelihood of moderating inflation in the US or Europe is zero. And therefore the central banks are going to have to become more aggressive rather than less aggressive. For the first time since God was a boy, I feel the Blue Angels are finally beginning to top out. You can see this very tiny wiggle that we have down, and that to me indicates where the likely top to these market rallies is. It's around 4250, 4300. And really, it's very hard to see it trading above there. If the bond markets continue their upward yield trajectory, we are far more likely to get a compression in multiples. And now that we have this, let's see if I can actually enlarge that so you can see better this tiny little wiggle down in the Blue Angels, in the forward earning expectations. That to me says that the best we can hope for is so somewhere around the times 18. But really, if we get a follow through in yields, we will actually get a real dump in NQ, and that is going to take us down towards this times 16 Blue Angels. It all depends on bond yields, and therefore it all depends on, to me, it all depends on the price of oil. If we go towards 140, there is very little doubt that the central banks will respond with very hawkish moves. And that is going to just, make the market come down. I don't think it's going to happen yet, but we are getting the first indications that the market basically can't expect higher earnings with what is going on in the world. To me, this becomes the most important chart. Equal weight consumer staples over discretionary. We had a very nice rally in that component, and that boosted all the indices. It should be obvious that XLY and XLK, but these are both sectors which are incredibly sensitive to interest rate moves. What the consumer does in the future depends exclusively on how much disposable income they have. And the higher the price of oil, the higher the price of fuel at the pump, the less disposable income they will have. And therefore this line will move down. So really over the next several weeks, all we have to guess or evaluate is where XLY and XLK will go to. XLK will be directly tied to the interest rates, and XLY will be more or less directly tied to the price of oil and therefore longer term interest rates. New month, and therefore we can have a look at a new candle on the monthlies and enlarge it. And really the situation becomes pretty clear. This is going to be the battlefield between 42.40 and 42.75. And really that matches very well with the Blue Angels, what I showed you around the 4,300 level. As long as the market stays below this, the pressure will keep on being applied to the downside, and the eventual target is right here, 3620, 3500. That is going to be the eventual target over the course of a few months. Really as simple as that. And now that we have the monthly picture, we can go down and have a look at the very short term. The 195-minute chart actually shows you extremely well what happened last week, which is nothing. We stayed all week within the previous Fridays, or whatever it is, what date that is. That is the 27th. We basically stayed all week within the range of the 27th. Gives you very, very good technical levels, 40.68. As long as the market bounces and stays above 40.68, the pressure is still going to be to the upside to trade this 42.32, 42.55 area. That is about as high as I can see it, give or take 0.5%. And after that, hopefully we will have exhausted this move up and we'll be ready to basically start matching whatever yields do. I still think that this is a sideways move in equities per se. The absolute level of equities is being determined by the bond yields, by long-term bond yields, and equities are just basically being, they are just being taken up and down according to the expectations of the forward earnings and the multiple compression that is going on. There is no doubt that 99% of everything that's happened to equities this year is actually multiples compression. And as yields go higher, that multiple compression is likely to become greater. Therefore, unless bond yields justify higher levels, this market is always going to be a sell at these appropriate levels like 42.55. My clean chart illustrates this very well. You can see basically that 42.55 is going to be very, very important, give or take 0.5% up here. Love to see it. I think that the risk reward there, or maybe just higher, is going to be a wonderful risk reward for the downside. And if we can't break up through there, we will basically retest 39.83 at some stage. And that to me is basically the range for the next week. Up to 42.55, down to 39.83. That is what I would like to see, and it's going to be entirely dependent on XLY and XLK. NDX is as clear could be. 12,430 is the level that it mustn't break down immediately from, otherwise it'll fill this gap for sure and probably even trade all the way down to 11,846. It is by far the weakest of the indices, and it's showing you, how important bond yields are. If I am correct, and at some stage bond yields break higher again, I have no doubt that we will retest the lows in NDX. But for early next week, 12,430 is your line in the sand. Starts trading through there, it's going to come down quite hard and won't find much support until, let's say, 12,000. It's a very, very clear chart for the very short term. The reason why I'm not looking for an immediate breakdown in the risk sectors is because Europe and Japan are actually trading very well. And this is SPY over FEZ. And basically we are where we were when Putin invaded Ukraine. This is the reaction, and we've come all the way back down. So we've ignored the whole of the war, and we've ignored everything that the US dollar has done in the meantime. It's now in a very interesting position, and I will follow this chart next week and keep you updated as to what happens. Because if Europe refuses to come down, then I really see no way that the US, or no reason for the US to come down. I mean, think about it, the pressure is in European rates, as I showed you from the chart of the differential between 10-year notes and bonds. The pressure is now on the euro to maybe outperform slightly against the dollar. And in that case, why should there be any big move in the differential between US equities and European equities? There really shouldn't be at this point. And that is a bit of a conundrum. Why is Europe and Japan, why are they trading so well? I don't know, but this chart should be able to tell us which way the market is going to break. And given that spread differential chart, these levels in Europe become extremely, extremely important. 38.82 or 38.43, whether you look at it on a weekly or on a daily chart. Certainly on a weekly basis, if the market starts going through 38.43, I will be expecting a break up towards that 42.55 level in SPX. I don't think that the US should lag that far behind. I know that it's tech heavy and therefore yields are a problem, but really, I think yields should become more of a problem in Europe. And therefore, if Europe starts pushing up above 38.43, I would have thought the US will catch a bid as well. If this turns out to be the top in Europe, then there's very little hope that we can see 42.55. But to me, 38.43 for the early part of next week is going to be extremely, extremely important. And the other reason why I can't see immediate pressure on equities is simply because, the VIX just is not collaborating with nobody seems to be buying puts. Everyone seems to be already hedged. And really, unless we see the VIX trading even at lower levels, around the 2021 area, I really have no reason to expect anything in terms of lower prices from the SPX. And therefore, for the early part of next week, I just can't see that we're going to have that much pressure in the market. The VIX needs to come down to these levels, 21.5, 22, to start feeling that we are likely to bottom in the VIX. Until that happens, I really can't see the pressure coming in. One last chart that I want to show you is the differential between volatility in Europe and volatility in the US. It's now here at minus 200, 190 minus 200. And as you can see, this has historically been as high as it goes in terms of differentials. This is M22 against M22. It only has, what now, about 10 days to go to expiry, so it might not be the most interesting or the most representative chart. But if you set it up so that you're looking at the interest rate, at the volatility differentials between all the various months, it will be very interesting to see if that starts coming down again, because I really don't think that the US can have very much downside without the VIX going out, and the VIX can't really go out unless the V stocks volatility goes out. It just makes no sense to me that you can have zero volatility in Europe with all the problems that Europe has, and have that much higher volatility in the US. And that is going to be very interesting as a possible signal that volatility is returning to the risk markets, and therefore that the markets can go, that the US markets can also go down, because I really don't think that they can go down very far without Europe cooperating. And Europe will not start going down unless their V stocks starts going up in price, and therefore this differential starts coming back down. I will be looking at that V stocks VIX differential very hard next week. Until it starts moving, I think the path of least resistance for the market and the pain trade is still higher in S&Ps. But there we are. I've changed all the levels, and I will be tweeting any changes to them as we go along. Have a wonderful weekend, and tweet you on Monday.